Welcome to FX Tech, your source for professional Forex analysis. This week, we're breaking down the NZD/USD pair for the period of December 1st to 5th, 2025. We'll examine the major bullish breakout, the key news events driving the market, and the critical technical levels you need to watch. Stay tuned as we dissect the fundamental and technical shifts that have reshaped the Kiwi's outlook and provide our data-driven forecast for the weeks ahead. Let's get started. The New Zealand dollar has confirmed a major bullish breakout, rallying an impressive 3.5% from its November low to test the critical 0.5800 resistance level. This surge saw the Kiwi become one of the week's top performers, while the US dollar languished as the weakest major currency. The rally was technically significant, smashing through the September downtrend line, the 50-day moving average, and multiple resistance levels, signaling a potential reversal of the multi-month downtrend. 5 critical news events fueled this powerful rally. The most significant was the weak US ADP employment report, which reinforced concerns of a slowing labor market and cemented expectations for a Fed rate cut. This was compounded by the RBNZ's Hawkish Pause, a risk-on market sentiment, and even speculation about future Fed leadership. Together, these factors created a perfect storm for broad-based US dollar weakness and a surge in the Kiwi dollar. The core fundamental driver is the widening policy divergence between the RBNZ and the FED. While the RBNZ has signaled an end to its easing cycle, the FED is poised to continue cutting rates. This has made the Kiwi fundamentally more attractive. The impact is clear in the narrowing 2-year yield spread between the two nations, which has shown an incredible 0.94 correlation with the NZD USD's upward movement, providing rocket fuel for the rally. Technically, the breakout was decisive. The pair broke the September downtrend line, cleared the 50-day moving average, and surpassed key resistance at 0.5690 and 0.5755. Momentum indicators like the RSI and MACD have turned bullish, confirming the shift in market structure. The breakout from the prior falling wedge pattern suggests a potential long-term target near the 0.6000 level. While the rally appears stretched, the path of least resistance is now clearly to the upside. Here are the critical levels to watch. Immediate resistance is the long-standing pivot at 0.5800. A break above opens the door to the 200-day moving average near 0.5860. On the downside, 0.5755 is the first line of support, with the key level for the bullish bias remaining at the 0.5690 former swing high. As long as the price holds above this level, the bullish outlook remains intact. The major support remains the November low of 0.5580. Our short-term outlook is cautiously bullish, with a likely range between 0.5690 and 0.5860. The market will be driven by the Fed's decision on December 10th. We see a 60% probability of a bullish breakout above 0.5800 if the Fed's message is dovish. There's a 30% chance of consolidation within the current range, and only a 10% chance of a bearish pullback towards 0.5690. Expect volatility and potential consolidation ahead of the Fed announcement. In the medium term, the outlook has shifted to neutral positive. With the technical breakout confirmed, the path to the 0.6000 psychological level is now open. We assign a 65% probability to this bullish case, provided the 0.5600 support zone holds. A neutral, range-bound scenario has a 25% probability, while a bearish reversal below 0.5600 is a low probability event at just 10%. The key is for the pair to hold above its recent lows. While the outlook is positive, risks remain. The balance of risks is tilted 70% to the upside, driven by continued USD weakness and policy divergence. However, there is a 30% chance of downside risks materializing. These include a surprisingly hawkish message from the Fed on December 10th, profit-taking after the sharp rally, or a failure to break the major 0.5800 resistance pivot. While we favor the upside, near-term caution is warranted. In conclusion, the NZD/USD has undergone a significant character change, confirming a bullish reversal. The move is supported by both fundamentals and technicals. Our trading guidance is to buy on dips, with pullbacks towards 0.5755, offering potentially attractive entries for long positions. A stop loss should be placed below the 0.5690 support level. The ultimate targets are 0.5860 and then 0.6000. The Kiwi has turned a corner, but the Fed's message will determine the trend's sustainability.